Well, the Finance Ministry a few days back mandated 7 PSUs to sell tax-free bonds to raise over 40,000 crore rupees this financial year. Another tax-free products are here to tempt Indian investors. And on Smart Money today, we tell you what you need to know before you decide to invest in these tax-free bonds. And to guide us, we have with us Anil Chopra, Group CEO and Director of Bajaj Capital. Thank you so much, sir, for joining us. Do you believe that this is an opportune time for really tax-free funds to come in?
Very much. Actually, all the tax-free bond investors, were waiting for it for a long time, because in the last financial year there was not even a single issue. Prior to that we had tax-free bonds, but this was a welcome announcement which was made in the budget this year, and we have been receiving inquiries from large set of investors right from April onward as to when can they have the opportunity to invest in tax-free bonds. And we understand that they all are now preparing to launch their schemes sometime later this month or in August. So this is excellent timing, because a lot of clients are sitting on cash and they are waiting for this wonderful opportunity to lock their funds for long term with expectations of very attractive tax-free assured returns for a period of 10 years or 15 years or 20 years.
All right, Mr. Chopra, my question therefore is that what kind of investors should be looking in to invest in these tax-free bonds? We see when the tax-free aspect comes into picture, it automatically becomes attractive. But for somebody who's looking to make it part of their portfolio, what is the consideration that one needs to look into when selecting a debt category and therefore looking at tax-free bonds, whether it's your fixed deposits, your debt mutual funds, what is your advice?
Well, very clearly, first every person needs to decide the ideal asset allocation for him, and asset allocation would depend upon the client's risk-taking appetite and what life stage he is. So supposing somebody is young in the 30s or 40s, then he can definitely take much higher risk and he can allocate higher amounts to equity and lower to debt. And generally the thumb rule is 80 minus your age should be invested in equity and remaining in debt. But when it comes to tax-free bonds, here very clearly these are ideal only for such investors, those who are in 30% tax bracket. These are not ideal at all for those who do not pay tax or who are in 10% tax bracket, etc. So there is a large section of our society, so-called rich people or high net worth individuals, who are in 30% tax bracket, and for them the investment in tax-free bonds make a lot of sense, because there are no other comparable instruments available. And so definitely all those who are risk averse, who like the safety of their principal, and who also are looking for regular return over a long period of 10 to 15 to 20 years. There is a lock-in here, as we all know that there is no early liquidity available in these bonds. So those who can wait for 10 years or 15 years or 20 years and are completely risk averse and are looking for regular return, wealth creation is not their goal. They do not have a goal upcoming for which they need to accumulate wealth. For such investors, tax-free bonds are the ideal option.
So there are plethora of options, as we pointed out, which will be coming and knocking our doors as far as tax-free bonds are concerned. What is it that investors need to look into and weigh when they pick up their tax-free bond?
Well, if we make a glance on the other options which are available for such investors, those who have already got a portfolio in equity and now are looking for safe havens, then bank deposit is clearly an option. But we all understand that bank deposits, normally the interest rates are offered for 1 to 3 years, and that too the interest rates are completely taxable. So if one gets about 8 to 9% FD interest, and that too taxable, the after tax return is much lower. And as we are in a growing economy era, and we all are expecting that interest rates will fall in the years to come, it makes much better sense to lock your funds at a higher interest rates for longer period, rather than to invest in some other instruments like bank FD, where you are not sure after maturity of 1 year or 3 years what interest rates will be offered to you. Then comparing with debt funds of mutual funds, there also the tax option clicks in, only when you have waited for at least 3 years, because there is a lock-in period of 3 years or higher. But as the interest rates go down in our country, even the returns from debt funds also are expected to be going down in the years to come. But here is an option in tax-free bonds where you can be assured of an attractive rate which you already know for a long period of 10 years or 15 years or 20 years. For somebody who has that kind of horizon and is willing to wait that long, definitely tax-free bonds make much better option.
What about, the fact, as we pointed out, 7 tax-free funds, tax-free bonds are expected to really come in as in this fiscal. So if an investor is to choose as to which one should I be picking up based on, which PSU is issuing, how should that be weighed? How should an investor look into, what is it that investor need to look into before deciding as to which PSU really, whose tax-free bonds they should pick up?
Well, very clearly, the government has given the permission to 7 of the very profit-making and public undertakings which are in infrastructure finance areas. The biggest allocation has gone to National Highway Authority of India, NHAI. As we all know that our country still needs a lot of infrastructure and highways, and NHAI is doing a great job there, and it has a good track record, etc. So, and it has the highest allocation. So that is clearly a very clear option. And even the other companies also, there is very little to choose from, because whether it is NTPC or it is IREDA or it is HUDCO or it is Indian Railway Finance Corporation, all these are 100% government of India undertakings with very, very high safety. One should look at the rating which these enjoys, and most of these companies have AA, AA plus or AAA rating. But higher the rating, the interest or coupon rate would be 5-10 paisa lower. So that is the trade-off one has to look into. But as I said, the very little to choose from A to B to C. But if one was to stick to only one company, I would suggest that National Highway Authority of India seems to be a much better option.
So generally, when investors get a tax-free tag, they get tempted. So a clear advice that you would probably be giving it, that do not put all your eggs in one basket. So even if you're looking that it looks as a secured option, as you pointed out, you have a backing, you're assured that after 10-15 years, this is the amount of some money that you will get, and that too tax-free. Shouldn't be the criteria that you park most of your money there. It has to depend a lot on various other factors as well.
Well, what you are saying makes a lot of sense. Diversification is something which is always appreciated. And I would say that if somebody has only, say, 10 lakhs or 20 lakhs to invest, then even choosing one of these companies will not be a bad choice. But if somebody is to invest, 1 crore or 2 crores or 10 crores, then it would make a much bigger sense that if that amount is divided equally, into 4 or 5 of these companies, maybe a larger chunk going towards National Highway Authority of India, and the rest of it could be split between NTPC, HUDCO, and PFC, etc. So, if somebody is having a large corpus, then it definitely makes a sense to diversify across these PSUs, in certain ratio.
All right. So, as far as any investor who has his fixed deposit, for example, maturing, and we are already seeing fixed deposits rates coming down, would it be an attractive option for them to look as far as these bonds are concerned?
Definitely, this is strongly recommended. If some investors have invested their surplus funds in bank fixed deposits because there was no other option available, and they are paying high tax on that, it makes much more sense to encash those FDs on a premature basis and invest these funds in these tax-free bonds, because you would start getting a high tax-free coupon from day one, and that too assured for a much longer period. So yes, so definitely, if your bank FD is going to mature in few months, instead of losing out on this opportunity, it would be recommended that you break that FD and divert those funds into these long-term tax-free bonds, because this opportunity may not come again.
All right, Mr. Chopra, last but not the least, one caveat and the caution that we probably need to provide is that those who are wanting to grow their wealth, probably for them, parking money for such a long time, do you think would be prudent?
If wealth creation is your goal, then definitely tax-free bonds are not a suitable option for that, because tax-free bonds are mainly meant for preservation of capital, for protection of capital, and not for growing your capital. Because you are getting almost the yield of a 10-year GSEC, which is like 7 to 7.5%, etc. And even if inflation is about 6.5, you are still making 1% to 1.5% additional returns, which is not going to help you grow your wealth. So if wealth creation is your goal, then tax-free bond is not an option. You should rather be looking at other options like equity, mutual funds, etc. But if preservation of capital and getting tax-free returns which beat inflation on a long-term sustainable basis, then tax-free bond is an excellent option.
Well, thank you, Mr. Chopra, for joining us and guiding our viewers with regard to this upcoming option, which is coming after quite a time lag, but guiding us as to how they should be weighing it as part of their investment portfolio and making those smart choices. Thank you so much. Well, time now for a quick break. To get our expert opinion on your finances, email us, call us, SMS us, or tweet us. After the break, we tell you how to invest to achieve your goals. Keep watching Smart Money.